Hey everybody, welcome. John Bowens here with Equity Trust Company, broadcasting from Miami, Florida at the Grant Cardone 10X studio. I know usually I'm back at home in Cleveland, Ohio at the Equity Trust virtual classroom, but I had to come down here and visit Grant.
It's cold up there, so.
It's freezing. I don't know if I'll make it back.
Yeah.
That's all right. So what I want to do today, Grant, is talk about real estate, of course.
Okay.
So I have been training real estate investors for the last 15 years.
Wow.
I've trained over 60,000 investors, and most of them are real estate. And the questions that I'm getting right now, Grant, and I'm a real estate investor myself. I own residential properties. We make private money loans secured by real estate. And the challenge that we have as investors right now is finding opportunities. So I thought, who better to ask questions about, hey, how do you find opportunities in multifamily real estate? Because I know you're big into multifamily real estate. And for those of you that aren't familiar with Grant Cardone, check him out on YouTube, LinkedIn, various social media platforms. He's got a lot of information out there on real estate, business, entrepreneurship, so you can check that out. He's a best-selling author, so you can check out the 10X rule.
Always with an offer, too.
Right, with an offer.
Always with an offer.
With an offer. 10X rule, I've read that one, great book. The other one
How to create wealth investing in real estate, sell or be sold, be obsessed or be averaged, the closer survival guide. We got probably another 16 business programs that have been purchased by Fortune 1500, top Fortune 1000 companies, Fortune 500 companies.
Yeah.
The
be obsessed to be average. One takeaway I took from that is pay the price today to pay any price in the future. So as you know, Grant, I'm very passionate about self-directed IRAs, very passionate about using Roth IRAs and 401ks to invest in real estate, whether it's multifamily real estate or single family residential real estate. I'm an investor myself. And when I talk about paying the price today to pay any price in the future, I'm talking about funding our self-directed retirement plans, right? Putting money in those accounts first. But we'll get to a number of questions.
Sure.
Grant, let's jump right to it. First and foremost, I understand you have, is it 4.1 billion in real estate under management?
Yeah, we have about, adjusted with the market. So we've already adjusted for the market here in 2022. That's pulled back. Our cap rates have gone up, so it'll pull valuations down, even though we're not a seller of anything. We're actually buyers, very aggressive buyers right now, but we're sitting on about 4.1 billion, 12,000 units, 500,000 square feet of office, all cash flow positive. When we buy it, it will cash flow the month after we buy it. We averaged a 6% return cash distribution this year and sent out $50 million to our investors.
And I heard a stat, something about, are you the fifth largest real estate owner in
Florida?
Yeah,
we're in the top five.
Top five,
so
okay.
This is, these are giants I'm around, right? Blacks, this is who we purchase from too. We purchase institutional quality assets, the best locations. We never ever compromise locations. This could be a 2000 built building that's garden style, or it could be a vertical 25-story building in Fort Lauderdale on the water. So the asset could be different, but the location will never compromise location. We typically stay in the red states and let the blue states feed us, So we like those blue waves. You guys keep winning up there. Y'all win up there, we win down here. So we stay in very positive job migration, targeted cities and counties and states where there's job growth, and we just buy great assets.
Mm-hmm. So let's talk a little bit more about that. For investors that are concerned about the real estate market, I speak with folks that are brand new, as well as people that have a couple deals under their belt, and they're having trouble finding opportunities.
Right.
So can you speak to, in a very challenging real estate market, obviously we have a number of macroeconomic conditions that are sort of pressuring us right now. Can you speak to how you find opportunities even during the most difficult of times?
Yeah, so number one, you have to be talking to these people that own the assets. Real estate is a who game, not a what game. So it's like, who owns the assets that you want? Now, at the bottom of the food chain, when people are first getting started, they're looking at single family. Single family is not where the opportunities are. There will be opportunities in single family, but the real opportunities in real estate is where you can scale buildings. My first two deals were single family homes. It was easy for me to do. I put 3% or 5% down. I bought the house, flipped it, picked up 3 or 4 grand or 20 grand in one of them. But the real opportunity is where you can scale, and the assets value is based on the rents, not the comps, as you know, of the neighborhood.
Right.
So we're going to become a renter nation. The massive opportunity right now is Jeremy Powell this is going to be the biggest creation of renters in 100 years in America. We're going to go from where we were building homes in the 50s and 60s and building out the middle class. We'll become a renter nation. I believe we'll flip from a 60% home ownership to a 60% renter. That's already true in Houston, Austin, many cities in America. Miami's probably a 60, 55, 45 split, renters to owners, where in most parts of the country it's more owners, as you know.
Right.
So, for retirement accounts, like I had $2 million sitting in a retirement account that I had created over 25 years. It was sitting with Fidelity or Merrill or one of these guys, right? I didn't know what it was invested in. Bunch of funds.
Right.
I pulled all that money out with your help, pulled all that money out and went and directed it to real assets that provide me with the cash flow. That just goes back to my account. That provided me with the appreciation. These apartment portfolios, typically they'll double every 10 years because of the rents moving up. So we have 12,000 units that our average rent's about $2,000. We think over the next 10 years, those $2,000 rents, regardless of what goes on in the economy, if interest rates stay high, housing can't be bought, which means rents will move up. So if those $2,000 rents go to $4 grand, which I think is very, very doable. I mean, you look at 2,000 times 12,000 units, the amount of wealth that's created for people that have money in their retirement account, supported by this real asset that you can see with an address, with rent rolls, is just phenomenal.
Right. But let's talk a little bit more about that as far as retirement savings is concerned, because just recently I wrote an article about what I call the Great Retirement Savings Crisis. So, Grant, I'm not sure if you're aware, but the average American only has approximately $140,000 in IRAs. The average
average American.
Average 50,
140 grand in retirement accounts.
Yes.
Wow.
That's correct.
That seems like a lot.
Yeah, right.
Is
55. Well, think about it. And then we look at 55 to 64-year-olds have about $104,000 in IRAs in retirement plans. Is that enough for somebody that's 55 to 64 years old?
Well, it's not, now it makes sense. No, it's not. If you're 64 years old and you're now able to pull out, the problem is you don't have income. No matter how much money you have in your retirement account, the moment you start to pull it out, like you don't have dependable income, you're pulling away from the source.
Right.
The thing about real estate, you never pull away from the source. I never tap the capital. Right. So like we don't do redemptions. We were talking about this. We don't do redemptions. We don't do short-term funds. We buy assets and hold great assets and keep them for 10-year periods so that at the 7-year point, we can refinance that, send you your $140,000 back. Let's say the $140,000 was sitting in this real estate asset. Every 7 years, I should be able to recapitalize that money, send the $140 back to that retirement account. And you continue to get cash flow and infinite returns, immeasurable returns. They're no longer 6s and 8s and 10s. They're, I got my money back and we still own the asset. Now, the other big groups, syndicators, the Blackstones, the BlackRocks, what they do is they pay you out. They pay the investor out and say, that was a great experience, bro. Good luck. But that's when it just got good for the investor. So
let's talk about that a little bit more, Grant. So you have public real estate investment trusts and you have private REITs. So we want to talk about the differences between those two. Now, back to the retirement savings, I'm glad you touched on it. I find that during very difficult financial times, folks will raid their IRAs.
Right.
I call it raiding their IRAs. Why would someone do that, especially with a self-directed IRA?
Because the reason you're doing it is because you're scared. You don't know what's in it. You don't know what you're invested in. You're trading paper. Dollar bills. This is what I have not done. When I go earn $1, I don't trade it in for a piece of paper. I want to upgrade the quality of that piece of paper. I don't trust this. It says in God we trust, but I don't completely think God has anything to do with this piece of paper.
Right.
So what I don't want to do is I don't want to trade it for another piece of paper, Apple stock or Fidelity, Magellan, Contrafund, whatever the paper. It's just contrived paper.
Right.
What I want to do is I'm just a real estate guy. I love real estate because it's real. It's concrete, it's windows, it's
Right.
regulations and permits and tenants and termites and all the things that go with real estate. But when they're big enough, you don't have the problems.
Right.
I have a management company. But what I do get out of it is I get rent growth. And I trade a piece of paper that is depreciating in value with an asset that actually benefits from inflation. And I've been doing this for 35 years, long before inflation was an issue, the supposed issue that we have today. And so when inflation hits, if we're in a cycle of inflation, these real buildings will do better than Apple. They'll do better than Facebook. By the way, my buildings will last longer than Facebook, the company, maybe Microsoft, IBM. The average company today that is supporting most of those retirement accounts is 7 years. That's the average duration of a company on planet Earth. It used to be 70 years. Back in the day, Caterpillars last forever. But that's not the case now. Companies are being destroyed. There's 200 plus zombie companies right now, publicly traded companies that have multi-billion-dollar valuations that have no earnings, no revenue, nothing, right? So these real assets, particularly during crazy times, you're talking about raiding your retirement account. It's because people get scared and they don't know what they're invested in. They're like, let me have my money.
Right.
Like if this kid, Bankman, if he would have been invested, if he'd have had $38 billion worth of real estate, he could have stole some of it, but he couldn't have stole all of it.
Right.
Because real estate is real. And I think we're going to see more and more people here in the next, particularly with what's going on in the stock market right now. S&P's down 25%. Some of the FANGs are down 60 and 70%. Bitcoin's down 70. When we see that, people are going to start saying, I want something real. And this opportunity in 2023 is going to be unbelievable for real estate. I believe the biggest in our lifetime.
So let's talk about that. But before I do that, can I have that cash for just
a
minute?
Sure.
So back to
somebody's going to take it.
Back to the retirement savings. So people during difficult financial times, I find they will raid their retirement plans.
Right.
And Grant, I've even seen it where people will raid their retirement plans and then they will use that money to go out and invest in real estate, whether it's single-family residential properties, private money loans, could be a private equity type opportunity, could be a multifamily real estate fund. And they're paying all this tax and penalties to take the money out.
Yeah.
And then when they have the money, they invest and then they pay taxes on the profits or the growth.
Yeah.
Instead,
my sister was going to do exactly that, what you're talking about. She's like, I'm going to take my money. I said, you don't need to. Redirect it.
Exactly.
You're self-directed. What is it called?
Self-directed.
Yeah. I said, just move it over, slide it over for $250. You slide it over. It's protected. And then you invest in that. And then you have the income coming in.
Yep. And then, so you took this out of your left pocket, I think,
yeah,
right?
Yeah,
so
yeah,
what I always say
exactly.
is you put it back in your right pocket.
Right.
Okay.
Right.
And that's your self-directed IRA.
Yeah.
Right?
I love it.
You're just shifting the money. You're not tying the money up. You're not locking the money up. Some people think that they're putting their money into a self-directed IRA and they don't have access to it. You can always get access to it, right? It's just you might have to pay some taxes or penalties.
Yeah. Well, I mean, if you have enough in that account, like $1 million of retirement money, which a lot of people have, millions and millions of dollars that they have almost forgotten. That'll pay you $5,000 a month in our funds. In any of our buildings, most of our buildings are targeted for a 5 or 6% cash flow, but these are phenomenal. Like these are Wall Street quality real estate. And it'll pay, on $1 million, you're going to earn $60,000 a year. You're earning $5,000 a month in new income into your retirement account. If you want to shave that off and live on it.
Right. Okay, good. So Grant, let's pivot for a little bit here. Let's go back to the private versus public REIT. And of course, for all of our viewers here, I, nor Equity Trust, nor Grant, we're not here providing any tax, legal, or financial advice. We're here providing education on how this works. There's not enough good education out there, in my opinion, Grant, about what's the difference between a private REIT and a public REIT. What's the risk versus return spectrum look like? What's a fund versus a REIT? So let's focus on first the private REIT versus the public REIT. What are the differences between those two?
Well, I can just tell you what we do, right? So I set this up for myself and my family to buy great assets. So I did not set this up to go public. It just kind of happened like that. People started asking me to invest with me. So number one is we're a long-term fund. We do not have 3 and 5 year promises. Most of the funds on Wall Street have a 3 and 5 year a term, and they tell you we want to be out in 3 to 5 years. But The nasty, dirty secret behind all that is that's not for you. So when they're like, oh, you can get liquid, you can be liquid in 3 years. That is not for you. That's for them to get their fees. Anything Wall Street offers you, the banks offer you is not some gift they're giving you. It's like going to the casino in Vegas. If they offer you something, the free drink is so that you get looped and spend more money than you would normally spend, right? It's not, they're not doing you a favor. So we don't do 3 and 5 year. We do a 10-year fund. This is
Okay.
money is literally virtually like invested in a real asset because we're waiting for rents to double. If the rents double or even do 50%, the property value explodes. And then we refinance and regrab that property. Number 2 thing that we do different is we return the capital to the investor and we do not kick them out of the deal.
Mm-hmm.
We keep them in the deal because that's when the deal got good. The big guys, Blackstone, Goldman, JP, this is their game, man. They raise money from the public, they return the money, and then they own that asset. Blackstone bought 10,000 condos in Miami in 2010. Mm-hmm. That's when I moved here. I'm like, okay, they know something. We came over here and we bought 12,000 apartments.
So they're your competition.
Oh, 1,000.
Yeah.
They're my competition, and they are where we will exit. I will exit my entire portfolio to a Blackstone or a BlackRock or a Starwood or these giants. These are giants. These are trillion-dollar companies that they need to eat 200 billion at a time. They don't eat little. They don't take little bites. They don't buy single-family homes. They're going to buy companies. That's my play with Cardone Capital. So one, we distribute every month. They don't because they want to hold that capital for 89 days without paying on it. We distribute to our investors every single month back to their retirement account or to the individual that has cash. 2, we have a 10-year cycle. We're only 37 months. Our average fund we've traded at 37 months. Somebody comes along and makes me an offer, good. But I don't want to be in a bad cycle either. We don't have this 3-year, 5-year. Also, we don't have preferred returns. Now, a lot of syndicators, and you're going to see that in this cycle right now because we've been in up cycles for the last 2 or 3 years. A lot of syndicators that are out building deals, a lot of builders are going to get in trouble in this cycle. Developers are going to get in trouble in this cycle. Tremendous opportunities out there. And a bunch of the big funds, if you've noticed any of the headlines about redemptions recently, they're gating redemption, saying, the redemption we offered you, we actually can't do it. So again, that's not a good thing for the fund, because when I can't pay out redemptions, that means I can't. I'm in trouble. I'm having problems, and then I have to start selling assets to cover the redemptions.
It creates shock too.
Dude,
right? Investors are saying, well, wait a second, what's going on here?
Yeah, and another little dirty secret is who gets the redemptions first? It's not Robert Smith. It's not you guys. It's going to be the state of Florida got their $2 billion back. Mm-hmm. CalPERS got their $5 billion. Harvard, the Harvard endowment that has $58 billion. These are giant machines. They're going to get theirs back because they're going to be like, hey, send me that money first before you send it to Robert and Betty.
Right. So let's talk about that a little bit. So
I just want to say this. We don't get money from those people. I've never taken a penny from any group that size.
And that's my question is the difference between working primarily with institutional or exclusively institutional investors versus retail investors. See, in my experience in 15 years in the self-directed IRA business, I've seen this transition where years ago, it was the large institutions that had access to what we call alternative investments.
Right,
And when we say alternative, we're talking about alternative to the traditional markets, the public markets. And then this movement towards alternative investments that Main Street can take advantage of, whether it's real estate in a multifamily type syndication or a REIT, or it could be someone going out and, let's say, buying a single family residential property. I know that you're not a huge proponent of that, but you could do that with the self-directed IRA.
Yeah, 100% you could.
So can you speak a little bit more to that, that philosophy around working with an individual investor opposed to a large institution?
Well, yeah, so I don't want to deal with the big institutions personally because they're going to put a gun to my head and they're going to set the rules, okay? Like I didn't know this when I started the game, but I've had these meetings where like, Grant, if you put in $100 million, we'll give you $1 billion. That's pretty, like it's pretty easy to do. I put in 100 million, a group be like, we'll give you 10 times your money. But that 10 times the money comes with, we're going to tell you when to sell it. We're going to tell you when we want our money back. We want an 8 or 10 or 12% preferred. I can't promise 12% to anybody.
Right.
Like I can't promise that it's going to be out in 3 or 4 years. But see, they want to do that because they're so big, they can be like, hey, you promised us 10. You're not going to get there. Sell the deal. And I don't want to sell. You don't want to get rid of assets. You want to own these assets for long periods of time so that when my retirement account is starting to cash out, not only can I start pulling money out of it, but it also gets replaced with new income from these rental properties.
Right.
I mean, these properties will last, if I can start pulling money out of what, 65?
59 and a half.
59, okay.
Yep.
So these real estate they'll be with me until I'm 99.
Mm-hmm.
Long after this retirement account would have already dumped out, I will still be getting cash flow. So that's why that's how I think about my retirement. I've been putting money in retirement accounts since I was 21 years old.
Mm-hmm. Roth IRAs?
Roths, everything. Roths, SEPs, anything, 401ks, anything and everything that was a way for me to stash $6,000 here, $4,000 here. I did it.
Mm-hmm.
Everywhere I could stash into a retirement account, I would.
Right.
And then when I figured out that I could self-direct it, I became so confident in my real estate because I've never lost any money in real estate. 2008, 2000, 1996, savings debacle. Real estate, income producing real estate is what got me through all those cycles. And even in 2008, 9, and 10, my 2 other businesses got destroyed. My real estate, my rental properties, even though the values went down, the cash flow actually was starting to pop up. So like right now, we have valuations on all real estate going down right now because of what's in the news, because of interest rates exploded, Jeremy Powell and whatever this guy's up to.
Jerome Powell, yep.
Yeah, the Jerome Powell, the devil. And so whatever they're up to, I don't know, but it's crazy because it's going to kill single family home purchases. It already has, lowest in 40 years. Mortgage applications, the lowest in 28 years or something. Mm-hmm. That forces renters, okay? And it forces more people to rent. And so even though the valuations could come down, the rents will continue to pop up.
Right. I'm glad you brought that up, Grant, because obviously there's a lot of naysayers out there, right? There's a lot of people that are saying, well, that's not necessarily accurate in the sense that, we're not going to see rents continue to rise. We're not going to continue to see asset prices rise. How do you react to that type of commentary? I certainly have my own opinions, but certainly very curious to understand, you being a real estate entrepreneur, investor, someone that's out finding opportunities even in very difficult times. How do you react to that type of commentary?
Well, I welcome what Powell's doing, by the way. I'm not a hater on it. I'm going to take advantage of it. I know what he's doing. I don't know why he's doing it, but I know what he's doing. I know who it negatively impacts. So I'll buy more apartments this year than I bought in my career. We may double our portfolio in this cycle. So right now we're looking at 5,000 units we would take down if I can figure out how to do it. What's the opportunity? I'm going to pay less than I would have paid 6 months ago. I'm going to be able to buy stuff at cap rates that are 60% higher than they were just a year ago. I'm going to be able to buy distressed assets. That doesn't mean the asset is bad. It means the seller is distressed. All these things I've alluded to, the redemptions, the 3 to 5 year funds, the 8, 9, 10% preferred returns. These things are putting pressure on giants. Okay. Right. Everybody, like your assets become your liabilities. This is a quote that I've become a bit famous for, because when you become so big, these big giant names I've been mentioning, they've accumulated tens of thousands of units in the last year. Just in Florida, I know one group that bought 10,000 units in the state of Florida on adjustable money. Okay, they were paying 2.8% on those loans. 10,000 units. Okay, the average one's 250 units. So let's say that's 40 deals. Is that 40 deals? About 40 deals, right? They have adjustable money on 40 different deals that went from 2.8 to 7. Those deals will all be in technical default as we speak.
The theme is, or the thesis here is, finding motivated sellers.
Rather than going and finding one house where a guy's in trouble, because the one house, the single family home is not going to be where the emergencies are this cycle, because he's got an Airbnb guy he can pop in there.
Right.
He's going to put a short-term rental. Short-term rentals did not exist in 2012. There was no Airbnb. The term didn't exist. Short-term rentals weren't a thing. They're here today, and that will resolve all single-family home issues. The renter will come in and take care of the note. So, but on the mass scale, when these big institutions bought a lot of units, like that's 10,000 in one state, multiplied times 30 states. Okay, the problem becomes epic. And CNBC's not talking about it. Bloomberg's not. I don't know why they're not talking about it. It's obvious to me. And those guys will have to, you've seen the redemption headlines. Mm-hmm. And those redemptions will continue to go. And the only way to get to feed the redemptions is to sell the assets. So
where are your apartment buildings located? I understand you have a huge presence in Florida.
Yeah, Florida, Texas, Arizona, Carolinas. We've been in the Carolinas. Georgia, I love Georgia. I mean, I'll tell you where I like: Utah, Nevada, Colorado, Texas, Alabama, both Carolinas, and Georgia, Florida, anything Florida.
And why those markets?
Because they have job migration. They have companies going there. I mean, Alabama's cheap. It's inexpensive. It's a freaking nice part of the country. The Carolinas, people like living there. A lot of tech companies are moving to the Carolinas. They're moving for Silicon Valley, saying, "Hey, you know what? The thing that we built here is starting to have problems. Mm-hmm. Urine in the streets. Got homeless problems in Santa Monica, California now. You got New York doing their crazy stuff. People get fed up with it. They're like, enough, and I'm going to go down to Florida, but they stop in the Carolinas. They're like, oh, Raleigh's beautiful. And people are discovering parts of America they never imagined. And companies are, look at Twitter. Twitter might move to Miami. They're going to either move to Miami or Texas. Elon moved Tesla out of Silicon Valley. So, when you guys say that rents are too high and they can't go higher, trust me, you have not traveled. You think the rents are high because you look at what the rents did in your market and you missed it. But go to Sydney, Australia, and you'll see high rents. Go to Singapore, you'll see rents that are $9,000, $10,000. Come to Miami and look at one of our buildings that rents for $3,000 a month, and you're like, oh my God, that's so much. Half of the building is from New York. Divorcees from New York that moved down here, and they're like, this would be $12,000 where I used to live. Mm-hmm. And they got a great swimming pool, and they got a golf course, and they got great weather 9 months of the year. And they don't pay any taxes. That's why these people are coming here.
Right. And then when you actually take down an opportunity and you move in, you move your team in, obviously, you have new operators in place.
Well, not always. Most of the time we're buying buildings big enough to where we don't have to change the management team. Okay. So I have built-in management. I have built-in rent rolls. We have cash flow day one. So when we close in January, we expect cash flow in February. Mm-hmm. We don't miss a month. We don't develop anything.
Any strategies?
I'm a coward investor.
Okay.
I like cash flow.
Okay. And so is there also a strategy around how you add value? How you increase the NOI on a property? Yeah. Can you speak a little bit to how that works?
So I have a big brand called 10X. I came from the customer service industry. I worked with Ford and Nissan and furniture companies around the world to improve the customer satisfaction experience so that people felt like they wanted to do business there. And that we teach companies how to make second sales and third sales. That was my start. I happen to be taking that money and putting it in real estate. I've now taken those customer friendly, customer satisfaction centric themes and started to lay them on our real estate. So we put 10X, the brand, on our portfolio. We have our occupancy is north of 96% across the entire 12,000 units. We have renewal rates in excess of most of the market, if not all of it. We're not a hands-off institution with 200,000 units. We pay attention to the client. We offer our clients, our residents, not our tenants, our residents, which are the tenants. We just talk to them different, treat them different. We even offer them to invest in our properties.
I'm glad you brought that up, Grant, about calling the residents, not tenants. Yeah. That's something that we've adopted we do own, by the way, single family residential properties.
Yeah.
So I know that you are very passionate around multifamily, but I will say in disclosure that I'm a single family residential property investor. That being
and
said,
those get higher rents than we get. So there's some real super upsides to the single
I'm
family.
from Cleveland, Ohio. Absolutely. Cash flow is a lot different in Cleveland, Ohio, or in Midwest cities compared to, down here in Miami, Florida. We also have clients that make loans secured by real estate, and then of course invest in multifamily real estate type opportunities. That's been a major part of our business for many years at Equity Trust Company. So
and I wasn't dogging on any of those things. They're just they're just we have a business that we're building, right? So if I could go buy 10,000 single family homes right now, I would, man. I'd jump on them if I could just close them all down in one day. I just can't scale that.
As predictable as possible model. But you did start, my understanding is you did start with a duplex, right? Many years ago.
No, I started with a single family home and I rented it to Janet. And I was making, I put, my payment was like $400 a month and I was making 200. I was like, I'm going to get rich. I was 29 years old. I said, I'm going to get rich in real estate. Like my first deal I ever did, I put $3,700 down. I was earning $2,400 a year. And I knew at 28 years old, I said, I am not going to get rich in business. I'm going to get rich in real estate.
Mm-hmm. So Grant, I know that out on social media, you have obviously a very bold personality. You tell it as it is, so to speak. You're known for that.
Right.
And I appreciate that. And, you talk about real estate, you're so passionate about it. As you can tell, I'm incredibly passionate about self-directed IRAs and 401ks. And I will say that those types of topics are not, they don't have a lot of sizzle, so to speak, right? A self-directed IRA. But what people I think really need to understand is how powerful that can be from a wealth accumulation and preservation perspective. Grant, I don't know if you've seen any of our video content, but I talk a lot about compounding interest in the absence of taxation. So when you apply that formula, you remove that variable of taxation, you have that compounding effect.
Yeah, exactly.
Apply that to the rule of 72. Right. And your money is going to double faster.
100%.
Right? Assuming that you're investing in the right types of investments.
You don't have to hit 10 anymore.
Exactly.
I don't have to have 10 for my rule of 72 to kick in, right? That you guys know about. So, because my money's tax free.
Exactly.
So, like 100% of your money works.
Right. And then with a Roth IRA in particular. So you mentioned a Roth IRA. The other thing I wanted to take some time to talk to you about while I'm down here, maybe after we get done with the recording, is I understand you have two children, right? And they work for the business, right? You have them employed in the business,
and they get a salary,
and they could potentially qualify for a Roth IRA. And I don't know if you already do that. Maybe you already do, but you can set up a Roth IRA. You can start they can start taking their earnings and making contributions to those plans. Imagine all those years, they got, call it 40 plus years of tax-free compounding growth. Imagine what that portfolio could look like over long periods of time.
I have a good imagination. So let's tap into it. I want my kids to be rich too. And my kids aren't going to be rich because I am. That'll have to be their choice. They need to do the right things with their money. So what we do is we pay them a salary. We take the salary. We don't give it to an 11-year-old. I don't give 30 grand to an 11-year-old. They have to do things for the 30 grand. We don't give them an allowance. We take the 30 grand, put it into Cardone Capital. I think they each have like 150,000 now. We've been doing this for 4 or 5 years. They get the distribution. I think it's $667 a month right now. And they can spend the 667. They cannot spend the 30, their salary.
No principal.
They can't touch their principal. So these kids will be millionaires by the time they're 18. Plus your Roth idea. How much can I do on the Roth?
So this year, in 2022, you can do 6,000 into the Roth. Next year, it's going to be 6,500. So here's, call me in January, February. Have somebody call me January, February.
Sure.
We'll open the Roth, and you can get a 2022 contribution in there and a 2023 contribution in there. As long as you do it before April 15th.
Okay, well, we can do that. So, but also the $600 they get a month, that's in the first 4 years. That's a cash account, not a Roth, right?
Right.
That money's not taxed. It's deferred because of their K1 that we give them.
Right.
So they're literally like first 4 years, because we accelerate for anybody that's just using cash and not. Do you ever talk about cash? Just cash? Cash or just the retirement money?
Well, I talk about both, right?
Because anybody's got retirement money's got cash.
Yeah. And the other thing, Grant, I should mention for all the audience members here is I'm the type of individual, I invest in real estate and I own property inside of my self-directed IRA and outside of my self-directed IRA.
That was my point.
And when I look at an opportunity, it might be a single family home, it might be a private money loan, and I say, okay, I'm going to use my non-IRA money because it makes more sense to do that. And maybe it's a depreciation play.
Right.
And then my IRA, I may look to invest in opportunities that make the most sense from a tax efficiency perspective. For example, a real estate investment trust. So when my IRA invests in a real estate investment trust and I get dividend income, so as long as everything is structured properly, that dividend income is tax exempt in the IRA. In a Roth IRA, it's tax free.
Right.
But see, outside of an IRA, it's subject to ordinary income taxes.
Right.
So not dividend tax rates, but ordinary income tax rates.
From the REIT.
Correct, from the REIT.
So we pass a K1 onto our investors, and they get the depreciation the same levels we do. So if they, so we like this year, I'll probably earn out of this other business, taxable income will be, I don't know, somewhere north of 50 million, okay? Which I'm proud of. That's my earned income. That has nothing to do with the real estate. My earnings from the real estate. My real estate purchases will offset all my earned income and wipe out that tax bill.
And what does that mean? Can you clarify that a little bit further for people that maybe don't understand is that concept of depreciation, pass-through depreciation?
These big giant buildings, like we did a building last December, it was $160 million. That building came with over $60 million worth of immediate depreciation. We bought it in December. We owned it for 4 days, and I think I wrote off $60 million.
Probably
the entire down payment, by the way. The entire down payment, maybe more than that. Might have been $80 million. We wrote off. We hadn't sold the building. We hadn't done anything. Hell, I hadn't even collected a rent check yet. But the IRS code this year still allows 100% depreciation. I think it goes to 80 next year. In what's called accelerated depreciation, we're able to split up between the land and the equipment on the property that typically in a house is written down over 27 years. We can accelerate all that depreciation to 1 year.
Okay. So before we start to conclude here, Grant, and I'm sure we could go on probably for hours going back and forth.
Days. You and I could do days. We should do this again, by the way.
We should. We'll make it a 5-hour class, right?
Yeah, why not?
We'll have to put that on the calendar. So what I would like to know is, what else do you want to tell the audience here in terms of, what are maybe some action steps that folks can take in terms of, researching this further, understanding more about multifamily real estate investing? I understand that you have a lot of education, a lot of training, all types of opportunities, but what would be a good next step for folks?
I wrote a book called How to Create Wealth Investing in Real Estate. You can buy it at Amazon or you can get it on my site for free. Amazon, I think they charge $30 or something for it. It's cardonecapital.com/free. And you can grab the book there. It basically shows people that want to go do this on their own what the perfect size deal is. 32 units, for instance. 32 units where the rents go up $200 a month. Let me be sure I got my math right here. Every 32 units where you can raise the rents 200, or they naturally, organically are going to raise 200. There's a lot of properties out there that are under, the rents are too low. Some old guy owns them. He's like, I don't want to raise the rents. He bought it in Cleveland 25 years ago. His cost basis is nothing. He's cash flowing so hard. He's like, he can't even spend all this money. He's a perfect target. 32 units where the rents go up $200 makes you $1 million. So if you can raise the rents $50 every quarter on 32 units, every time you can do that, you make $1 million. $50 becomes $1 million in new valuation. And that's what I would tell people to look for. Don't look for the single family that might go up. The better option is to have the scale of the doors to make one close, buy one deal. It is easier to get with a lower credit score even. With a lower credit score, it is more difficult to buy a single family home than it is a 64 unit property because the 64 units replaces your credit score. Okay, you're actually going to get a better, the lender says, I want to lend it to this LLC right here, not to you. So I have made so much money like this. It's unbelievable. And it doesn't quit making money. And even in bad cycles and tough times like we're going to go through, we're in a recession right now. We're going to have a housing correction. We're having it. It's in play right now. You're not going to be able to get a loan for a while, and you shouldn't. You shouldn't try to do these small loans because rates are too high. They are going to come down. And they're the biggest opportunity in America today is these big institutional quality 200, 250, 300 unit buildings that are owned by the biggest names in the world.
Mm-hmm. Outstanding, Grant. You know, I'll say as we start to wrap up here, obviously for our audience, Grant and I are very passionate about real estate investing. I'm very passionate about self-directed IRAs. I know, Grant, that you have access to utilizing self-directed IRAs. You use them.
Yeah.
You're very involved in that space. So we really appreciate that, and you being a promoter of this concept of a self-directed IRA.
Yeah, I did. All my family did this. Like my whole family. I did it first. I turned my family. I'm telling them, why do you have this money invested over here? You don't even know where it's at. I said, this is your money. You're not paying attention to it. You're not looking at it. And it could go in this one asset and get all the added benefits and avoid some of the struggles that we're all witnessing on Wall Street. Some of which the Ray Dalios of the world and some of the biggest investors, some of the legends are like concerned about the stock market rolling over.
Right, absolutely. You know, I'll say on a personal level, Grant, you know, real estate in and outside of my IRA has absolutely changed my life.
Yeah.
You know,
can you say that about any stocks?
I can. In fact, Grant, I'll tell you, I'll be fully transparent. Almost my entire portfolio is in real estate.
Right.
My retirement accounts,
How
my
many stocks do
self-directed
you own?
IRAs. Very few. So my
I own
portfolio.
one. And I'm an insider. I got to tell you, I have an inside track on this one stock. So I know what's going on there.
Okay, so that's one side. You know, I heard someone say not too long ago, they said, you know, what's the difference between stocks and real estate? It was at a conference I was at last week. And he said the difference between stocks and real estate is in real estate, insider trading is legal. Yeah. I never heard that before, right. You know, and, you know, it makes a lot of sense. Yeah. You know, we look for in real estate, we look for inefficiencies in the marketplace.
Right.
And we take advantage of those. You know, I can speak from experience. In the middle of the pandemic, I bought a duplex in the middle of the pandemic in Cleveland, Ohio for $63,000. And my goal was to not hold it for cash flow. I did this as a cash deal in my self-directed Roth and traditional. I actually partnered the two accounts together. We had about $15,000 in deferred maintenance. So the landlord was a motivated landlord, right? Just like apartment buildings.
60 grand.
Yeah, 63 grand.
Yeah.
Okay. And so over 2 years, we got the property stabilized.
Right.
So we had to evict a tenant. We had to get a new tenant in. It was cash flowing at $750 per unit. Again, this is in Cleveland, Ohio, different than this market.
Yeah, I know.
And then we sold it. We actually just sold it about 4.5 months ago. My traditional and Roth received $35,000 in profit. Wow. And we paid zero tax.
Wow.
Now, had I paid long-term capital gains tax, recapture depreciation, you got to run the numbers on all that, we would have paid about $5,000 in taxes.
Yeah.
And then we took that money right after that
Still
sale.
a good deal.
And we made a loan to a real estate investor who flips houses. It was a $100,000 loan, $50,000 for my Roth, $50,000 for my traditional. So I'm growing tax-deferred, tax-free, 8.667%. The property just sold. So we got the wire came in earlier this week. So $8,600 in profit, and that's tax-free.
Yeah.
So we try to do the passive private lending with our self-directed IRAs, and all that interest income is tax-free in our self-directed retirement plan. So, you know, while the market's doing this, obviously our portfolio, our self-directed retirement portfolios are doing this.
Yeah.
And that's the concept for, you know, a lot of the audience out there that's listening is, okay, how do I find real estate or other alternative investment opportunities that I can take advantage of? And of course, our clients, they're doing their own due diligence. As we always do, we encourage our folks to do their own due diligence on any investment sponsor, or any other individual that they might be partnering with. That being said, Grant, before we conclude, any parting notes or comments?
You know, just you know what you're talking about clearly. You're doing it. You know, that's the thing. Like you can't, you buy a piece of real estate, you know where it is, you know what it did. And this concept of real estate allows insider trading. It's true. Here's my rent roll. You want to see it? Here's my income. Here's the cash flow. There's the address. Go visit. Call them up and see what the rents are. Everything can be checked. And this is why, like, I work so hard for my money in my career, like most of the people in your audience. I don't want to lose it. And so when, you know, my brother, my sister, my mom, all these people, I said, look, be in real estate. It's real. As long as you know what you're doing. And I think in the final moments here is like, we are walking into that 60,000 home. You're going to see hundreds of them that a guy was trying to flip or he was trying to wholesale, he just got caught. The music stopped. The rates went up. And I think this is going to be a violent V, meaning values will go down. Smart people will move in and buy those assets at scale, okay? And then we're going to have a violent correction the other way. And I believe in the next 2 years, you'll see lower rates than you see today. And even in your lifetime, if this prediction comes true, everybody gets super rich. You'll have a 40 and 50-year mortgage to resolve the housing crisis in America. If we go to a 40, 50-year mortgage, which other countries have, we wouldn't be the first country. I think Japan's got a 100-year mortgage. If that happens, then housing will inflate to levels that you guys would be like, God, I should have bought everything in the neighborhood.
Right.
And I should have done it with my retirement account.
Right. Awesome. Well, thanks so much, Grant. And, lastly, I'll say that, I've had the opportunity and privilege to be able to self-direct my retirement plan, but I really owe it to equity trust clients, other investors, the family who owns and operates our company. They were mentors to me, the Desich family.
Yeah.
And they taught me just about everything that I know. And, I wouldn't be here. I wouldn't be in real estate. I wouldn't be talking to you if it wasn't for all of these people. I'm not a genius when it comes to investing. I just look at what other people are doing.
Yeah.
And like you say, Grant, I follow the money.
Yeah, exactly.
So I follow the money and I find opportunities. And, like you always say as well, you got to hustle and pay the price today to pay any price in the future. Yeah. And that's what we're trying to do. And that's what we're trying to do for our equity.
And you don't have, the thing about real estate is if you look at the top, the Sam Zell, the guy out of California, what's his name? He's the largest real estate owner in the country. Donald Brand. These aren't genius people. They weren't geniuses. They weren't well connected. They don't come out of Wall Street. They didn't go to Ivy League schools. They invested in real estate. It's a simple man's game. So it doesn't require a bunch of analysts and programs. It's like, oh, that's a great location. It's completely full. It's going to cash flow. Now, am I going to do it with cash or am I going to do it with my retirement money?
That's right. Awesome. Well, hey, Grant, thank you so much for spending time with me today. I
Appreciate
really
you.
appreciate it. Thanks for having me down here in Miami, Florida. Hopefully we'll make it back. For all of our audience out there, make sure to subscribe to our channel. Make sure to subscribe to Grant's channel as well. And until the next show, as I always part with, keep leveraging compounding interest in the absence of taxation. Thank you.